Do you ever wonder why wealthy investors seem to play a different game and win? In today's episode, we'll reveal the hidden habits, strategies, and mindsets that separate the top 1% from the average investor. If you've ever felt like you're missing a cheat code to investing, this episode's it. As always, I'm your host, Ryan, and we're joined with our panel, Bob, Nic, and Tyler. I'm going to go ahead and kick it over to Nic, who's going to kick us off with the first segment here.
Yeah, welcome everyone. Thank you for joining us today. We want to get started talking about leverage, and that's a conversation, a controversial topic, especially when we have super popular radio show hosts like Dave Ramsey who believe in zero leverage, and then the elusive top 1% that may not be so afraid of leverage. So to get started on that, I would say many of our clients do use leverage in different cases, not 100% all of them. It's not a blanket recommendation one way or another, right? But there are certain strategies that you just cannot employ or access without using leverage. And so we can talk a little bit about that. What do you think, Bob?
I completely agree. So as Nic's our investment guy, I look at it from a planning lens all the time. And oftentimes having leverage is beneficial to a plan. And whether that's a mortgage, or sometimes you can even take out debt against your investments, or even a car loan sometimes can make sense for clients. I think too often people are afraid of leverage or afraid of having any debt. And those that are oftentimes the most well off are just smart about debt. So I think that's the big thing when it comes to leverage. We don't necessarily need to be afraid of it. We just need to be smart about how we utilize it and how we fit it into whether it's an investment strategy or an overall plan.
Mm-hmm. Yeah, I think there's good debt and there's bad debt, right? Like, we don't want to stack up $20,000 on a credit card and be paying 18% interest. But
yep,
let's flash back a few years when people got mortgage rates at 2.5, 2.75. That almost becomes an asset now. Even though it is a debt, it's so low that we can put our money elsewhere and get it working better for us. So,
Tyler, sorry to cut you off there, but I think that's the thing. I think the word that comes to mind when it comes to leverage and wealthy investors, right, is arbitrage, right? And it might not be a word that is often heard outside of kind of our circles, but it's just being able to earn more on one investment and pay less on another one, right? So if you're utilizing debt properly and you can take advantage of that positive arbitrage, that's something that, hey, we're going to take that every time.
Mm-hmm. Yeah. And, business owners do this all the time, right? Take debt out to grow. You just have to be smart and have a plan. Like you said earlier, Bob, a plan for the leverage, a plan for the debt, and make sure that if things do blow up with that specific plan or that leverage, that everything's still okay.
Mm-hmm. Yep.
Mm-hmm. So guys, sitting here kind of more as the consumer, when I see the market go down, 20% or 10% like we did over the last month, one thing I'm thinking about is, okay, so on the ride back up, does it make sense to sell out of some of my less risky funds and buy something that's a little more leveraged, like a 2 or 3x leverage fund or something like that? Is that something you would ever recommend for a client? Is that a little too risky? What do you think?
Man, great question. I'd say if you can perfectly time that, then that is going to forever be a winning strategy. But the kicker is, like, usually markets don't move straight back up, right? Like, there'll be plenty of other down days where then you're experiencing a 2 or 3 time drawdown, and that can be a little painful for folks. But those levered funds, they have their place. They can work, and they do work. But yeah, for short-term money, I don't know, maybe you can make a quick buck on it. And there's times when, it's enticing, right? Like, you see those funds move as much in a day as you could earn in a whole year in like a money market, right? And so you're like, oh, wow, I could just make a whole year of returns super fast. And so, like, I get the attraction. Generally not something we're going to recommend for clients, though. On the average, in general, in those drawdown moments, we'll stick to things like rebalancing and, moving from things that have drawn down less into redeploying that cash into the things that have sold off the most, so that we can catch more of the upside.
Absolutely, Nic. And I think that goes to the smart leverage versus not smart leverage, right? Like, that almost in a way becomes gambling. And just to transition to a different thing that wealthy individuals do is they don't plan so much for the short term. They're not trying to hit, home runs immediately. They're planning for generations ahead, right? So if we have a plan in place and we're trying to take advantage of these short-term fluctuations with a highly risky leveraged fund, that's just going to put you in a worse spot potentially. Yeah, it could put you ahead, but if we're just hitting singles and doubles and, slowly building up our wealth that way, we can avoid having to take too much risk in a levered fund or something like that. That is, a completely different risk profile than even just standard equities.
A quick factoid on what we're talking about. I just saw that the most inflows into leveraged ETFs happened within like the last week. So
Wow.
people are thinking about this question. People are thinking exactly how Ryan's thinking. Like, I take advantage of the ride back up. But yeah, it was a great point on the gambling, Bob. Might as well just take it to the roulette table and throw it down and see what happens. Mm-hmm. Another point that we haven't talked about yet is levered funds. They have fees. Usually, their fees are higher. It doesn't track perfectly. So a lot of the times, you get more of the downside than the upside. If it promises 3 times leverage, some people may be wondering, well, it went down this much. Why'd mine go down more? Or it went up this much. How come I didn't get all that upside? So just another thing to think about.
Yeah. It's not a guarantee, right? Like they're trying their best.
And that's it. If I can jump in, I'll go as a math side of things, right? Just the math nerd in me says, hey, if you're in a levered fund and it goes down 50%, now all of a sudden you need 100% back up, right, to gain that back. So not only are the ups magnified, but the downs are magnified. And that's what makes it so risky and so hard to time that we would not recommend something like that generally for clients.
Yeah. That's when you go from the 3X to the 5X if it's down 50.
You just lever up again.
Yeah. We have 3X now. I bet 5X is coming soon.
Gotta be.
One of the points you made there, Bob, I think speaks a lot to the next segment where you said, they're not planning for that short-term gain. So one of our next segments is they plan for 3 generations, not 3 years, talking about these wealthy investors. Maybe you can speak a little bit more than that, Bob.
Sure. I think that when we talk to folks that want to leave, whether it's a legacy to kids or grandkids or organizations that they care about, schools, whatever it may be, right? They understand that money, the longer it's sitting there and it's invested, the better it's going to do and the better your chances of investment success are, right? So when you have that mindset of like, hey, I'm putting this in and I'm going to be waiting whatever the time period is, but thinking in longer terms, thinking in decades versus just like, hey, I want to get as much return as I can this week, this month, this year, you're going to A, take advantage of the growth in the markets, but B, you're also going to avoid, inappropriate taxes and inappropriate emotional impacts, right? Like these things are just behavioral things that wealthy folks tend to do because that's the mindset that they're in. And I would love for more people to have that mindset to be able to, take advantage of the markets in that way.
Yeah, most people think the wealthy are doing some crazy complicated, type of strategy when in reality, a lot of the times it's just simple, but they have the patience and the wherewithal to sit through the turmoil because they have that long-term focus. So I think that's super important. Focusing on the long term, making sure that your decisions nowadays are aligned with that long-term vision.
Go ahead, Brian. What do we got?
I was just going to say, sitting here as the consumer, the first thing that comes to mind is they've got the luxury to sit there and kind of ride out and really see the fruits of their time.
Yeah, and I don't think it has to do with necessarily the dollar amount that's invested, right? Even if we have clients that have been putting away consistently $100, $200 a month for 10 or 12 years, that, it might not have started out with very much, but now because they have been patient, they have been able to see the fruits of their labors, right? So, again, it goes back to the mindset being of you don't need to get rich quick. If you can set a plan in place and consistently invest, control the behavior, that's going to do far more for you than trying to find the next hot thing or the next hot tip that, wealthy investors do. They just have patience.
Yeah, to your point, Bob, I think people need to start earlier than they think. Reach out to somebody like us earlier. When a client comes to us and they're 64 and they're like, "Hey, I want to retire next year. What can you guys do?" We don't have a magic 8 ball or a genie in a bottle that we can, create some crazy strategy in a year that just makes them wealthy.
Yep.
Like you said, just start early, start packing it away, and things become easier as you get down that road.
The only thing I would add to that is that on topic of like earlier is also teaching those habits to your kids. I cannot tell you how many times I've encountered wealthy clients who have not passed down the knowledge or the drive or the habits that they use to create wealth down to their children. And so then their kids are unequipped when it comes time for them to meet the real world, or when it comes time for them to inherit the wealth. They don't have the habits. So thinking longer term on that side of it can make even a bigger impact than the greatest investment strategy, right? So if you equip your kids to handle those funds on the receiving end of that.
You don't want your kids to turn out like Paris Hilton, Nick?
Man.
Well, you got to pick on Paris for
the same thing with lottery winners, right? Like, that's like, even if you hit it big, if you were the chosen one, the lucky one, it's the habits that break them, right? It's not the wealth.
Athletes.
Correct.
I mean, every day you read a new story about this athlete made $100 million and is going bankrupt. Habits.
Awesome. Thanks, guys. That makes it pretty clear that behavior's got a large impact on the outcome here. So another thing I wanted to bring up, it could be our next segment, is taxes. So how are the wealthy thinking about taxes? Something that's a little more out of their control, especially in the future, as those taxes can change with different administrations and everything. So I'm not sure who wants to take it. So go ahead and fight for it and kick us off.
Well, I'll go ahead and start, I guess. I think from a tax perspective, wealthy individuals, they're very smart about how they pay taxes, but they're also not afraid to pay taxes. And I think that's one of the big takeaways from this is we can't let the tax tail necessarily wag the dog, right? Like we hear that term all the time. I try to push it forward to clients, but we can't let taxes be the only reason that we're making some investment decision or retirement decision or any number of things, right? Like I've even had folks ask me, "Hey, Bob, I'm not going to, turn on my Social Security at 70 because I don't want to pay more taxes." Well, heck, I'd rather have more income than not have the income. Doesn't matter if I pay more in taxes. So being smart about it, but also not being afraid of it, I think is a very important, mindset to have.
Yeah, I'll take it through a business owner's mindset. When you're looking at your business and you're trying to grow, you're looking for ways to invest back into the business in a tax efficient manner. And a lot of these things can be write-offs, right? And so I think business owners are keenly aware of taxes and how that affects their business and, being as efficient as possible with those decisions.
Mm-hmm.
Yeah. I see so many business owners too that are like they're down to earth, like normal people. They're used to touching things with their hands, like they're the builders, the creators, and the stock market or investments is just this like abstract thing in the clouds. And so they're scared to even put any money into it because, they have lived through a lot of different tough financial markets. Many of them lived through 2008. And so they're just scared of investing as a whole. And so like, they don't even care about the tax benefits. They're like, I don't know, this investing thing in stocks is a little crazy. And so I'd encourage anyone to realize the stock market is the most modern, fastest, efficient way to build wealth that's ever existed in all of mankind, right? Like it is a great tool that's highly accessible to everyone. And there's that, but then also on the topic of taxes and it comes to investments, I'd say, like going back to what you said, Bob, like an investment has to stand on its own 2 feet without the tax benefit, right? Like if you are hunting down investments purely for the tax benefit, most of the time those are A, like really small pool to fish from, and B, super complex and don't really produce as much benefit as you think they would.
There are some wild ones out there. Like, invest in this pipeline in South Dakota, and you can get 80% deduction over the next 27 years. You know, it's crazy what people come
They're
up
literally just selling tax loss credits, right?
Yeah,
like that's
exactly.
what a lot of the investments will sell. And they'll target these high income individuals who just want to reduce income in 1 year, right? To pay less in taxes in that year. And what a lot of people find out is that they end up either paying a lot more in taxes than they would have anticipated over the long term, or the returns on it just aren't worth the reduction in taxes that you're getting. So again, I think going back to not being afraid of paying taxes, but to Nic's point, picking investments based on their merit, and then also positioning those investments in the proper way to maximize the sort of tax code as the IRS has currently laid out. So like if there is something that spits off high taxes, put it in your IRA or put it in your Roth, right? So then we can defer it or avoid it altogether. So tax location is another big thing that wealthy investors do, or just smart investors in general will do to help avoid being, kind of pulled in by the shiny new toy that promises some tax benefit or whatever it may be.
I think part of the problem too for the average consumer is just thinking that the tax system is so complex, there's no way they can understand it, which it definitely has a lot of complexity, and there definitely is a lot of value in having tax experts to help you. But the amount of people that I've met that don't even understand that, like, our progressive tax bracket doesn't mean you pay, that tax rate for every dollar you make. It's only the amount over that. It's mind blowing.
Yep. Yep. It really is. And so I think that comes back to just some education and understanding of the tax system, but where we try to have such a, helpful impact to clients is helping to understand kind of the pros and cons of these different investment strategies. And quite honestly, bust in a lot of the myths that you may see out there as far as what folks do to save themselves in taxes when it comes to wealthy folks.
Well, I know you're just waiting for it, and I heard you use the word myth, so I'm going to go ahead and let us kick into the segment that's going to end this portion for us, which is Mythbusters. Rich people don't do this. So go ahead and hit us with your quick round of misconceptions about how the wealthy actually invest.
All right. Well, my favorite one that everybody hears about is building your own bank and utilizing insurance to be able to do that. I can't tell you how many times I see it on Facebook or Instagram or TikTok or any of these financial influencers that throw it out there. But I will tell you that, yes, that is a potential strategy. That is something you can do with life insurance. But I have worked with hundreds of clients over my years in the business, and I can count on one hand the number of people that actually makes sense for, whether they're worth $10 million or $1 million, right? So trying to be your own bank or build your own bank is just a sales tactic of insurance salesmen. And I would encourage everybody to avoid those at all costs.
The illustrations that they show you, Bob, are so enticing, right? Like, oh, look how beautiful this looks over 30 years. The problem is clients usually can't stick to the plan, or something comes up and that just blows the whole thing up. And I don't think people are aware of that, or that can happen, because obviously the insurance salesman isn't focusing on that part of it.
Yeah.
Maybe the problem is they're not doing their part. They're not finding their 5 guys underneath them to go sell the policy as well.
We're gonna get a lot of heat for this segment.
Well, one of the other myths that I hear a lot, like, rich people don't do this, definitely. And it's funny because, like, even folks of my generation are, like, when they first start getting into investing, they get all hooked on this idea of, like, passive income. They're like, I need dividends, I need rental income, I need XYZ. And like, dividends specifically, I always kind of chuckle a little bit when I hear that one. And it's funny. It's like only investing in companies that are not growing, so that you have extra cash on hand, so they're just distributing it back to the shareholders, right? It's like, versus the companies that are growing are generally retaining that cash flow, like Amazon or Tesla, even Apple. Like, they barely distribute any cash back to shareholders. Nvidia, and I always say, like, you can create your own dividend just by selling off some of those shares after it's appreciated, right? And you can control the cash flow in that situation, and you get preferential tax treatment on the long-term capital. So, like, all those things, like that's just one of the common myths I hear.
Yep.
Yeah, I think the big one for me is that all wealthy people own a ton of real estate. Like that's the path to wealth. And I can't tell you how many people I know who tried to go down that route and hated it. Being a landlord, having to deal with property issues. I think social media and influencers, they make it look so simple and so easy, right? The passive is the big word.
Yeah.
Nothing is passive in the business world, especially real estate. And so I think, people always thinking, hey, I got to buy an investment property. Like maybe there's a better use for that money, right? Or a better strategy. You don't have to be in real estate.
Yep. Tyler, I think that's a great point. One thing I always try to bring up to clients is something we call ROH, return on hassle, right? Like how big of a pain in the butt is it to have this investment? And I can tell you, listen, there are people that make a ton of money off of real estate and they do incredibly well, right? And they love it and they enjoy it. And it's not a hassle for them because that is what they're interested in. But to just get 1, 2, 3 rental properties and it be a pain in the butt for you to handle it, so oftentimes you can replicate that with, investing passively and truly like an index or whatever it may be. Like you don't need to have all that hassle in order to get the income or the returns. As Nic alluded to, you can create it yourself through a sound investment strategy, distribution strategy, whatever it may be.
Better off investing in REITs, right, Nic? Just get real estate bundled up nicely for you.
Yeah, REITs or private credit is like one of the best ways that we like to solve for income right now, as outside of just straight mathematical guarantee. Like we can always use insurance-based products for that, but like there's a lot of ways to solve for those income things, income needs or desires or wants or wishes. And I can tell you that the answer is very seldom you need a big passive real estate portfolio, or a high dividend investment strategy that has a collection of those companies. So, yeah.
Awesome, guys. I think you've done a great job of highlighting the fact that the wealthy investor doesn't really know anything more than the average investor. It's just find someone who can help you, and hopefully that'll help you be able to accomplish the same things they can. So with that, I'm going to go ahead and kick it off to our winner of the week, which is Tyler. And I know you've got a rant you've been dying to come after the NFL draft. So just go ahead and get into it, man.
Yeah, I'm gonna take my sweet 30 seconds here to rant about the Bengals and how they draft and their scouting department. We have the smallest scouting department out of any NFL team. We have 5 scouts. No wonder we draft so terribly. The Eagles, Ryan, I think have like 30-something scouts. Like, how are you even in the same league? I am extremely unhappy with our draft. Now, I hope they prove us all wrong, all of us Bengals fans, when the season comes around. But there were some head scratchers. So, the Bengals are doing Bengals things. I'll be a lifelong fan and have been, but would love to see that scouting department add a few employees.
Well, at least they're not the Browns.
I'm going to say Ohio football as a whole. Just
yeah, you guys are struggling over there. I'm not going to lie. Awesome, Tyler. Yeah, I mean, maybe you guys shouldn't have spent all your money on Joe Burrow, and then you'd have more money to pay scouts, but I don't know anything. But thanks for joining us this week, guys. We will see you next week. As always, it's been Ryan, Bob, Nic, and Tyler.